Risk management is crucial in binary options trading because of its all-or-nothing nature. Without proper strategies, traders can quickly deplete their capital. One effective risk management strategy is the 1 to 5% rule, where traders only risk a small percentage of their total balance on a single trade. This prevents significant losses from just a few bad trades. For example, if a trader has $1,000, they should risk only $10 to $50 per trade. Another key strategy is diversification, meaning traders should not rely on a single asset or trading type. Instead, they should trade a mix of currency pairs, stocks, and commodities to spread risk. Using stop-loss and take-profit levels is also essential, even though binary trading doesn't have traditional stop-loss settings. Traders can manually control risk by setting a daily or weekly loss limit. For instance, if a trader plans to risk $100 per day, they should stop trading once that limit is reached. Hedging is another useful technique where traders open opposite positions on correlated assets to reduce risk exposure. For example, if they place a call trade on EUR/USD, they can place a put trade on GBP/USD if both pairs are expected to move similarly. Avoiding overtrading is also key. Many traders lose money because they chase losses or trade excessively. It's important to have a clear trading plan and stick to it, even if there's a losing streak. Using demo accounts before live trading allows traders to test strategies without risking real money. Practicing on a demo account helps build confidence and refine trading approaches. Analyzing market trends and using technical indicators like RSI, Bollinger Bands, and moving averages can improve decision-making. Relying purely on instincts leads to unnecessary risks. Emotional control plays a major role in risk management. Traders should never let greed or fear dictate their actions. Implementing risk-reward ratios, such as 1.2, ensures that potential profits outweigh potential losses, helping traders stay profitable in the long run. Choosing regulated brokers also minimizes risks related to fraud and unfair trade execution. Many unregulated brokers manipulate trades, leading to unnecessary losses. Avoiding high-risk trading times, such as during major news events, prevents unpredictable market swings. Economic reports, central bank decisions, and geopolitical events can cause sudden price spikes, making trading riskier. Using compounding strategies wisely can enhance profits, but excessive reinvestment of winnings increases exposure. Instead of reinvesting 100% of profits, traders should withdraw a portion to secure earnings. Limiting bonus dependencies is important because many brokers offer bonuses with hidden conditions that make withdrawals difficult. Traders should carefully read terms before accepting bonuses. Lastly, staying updated with market news helps traders anticipate price movements, reducing unexpected losses. Risk management isn't just about avoiding losses. It's about making consistent, calculated decisions to maximize profitability while keeping potential losses under control. By implementing these strategies, traders can navigate binary options trading more safely and increase their chances of long-term success.